This trade right here is an A+ setup. So first off, liquidity is everything, okay? So what do we have here? Right here, this right here is our draw, because that is where retail have a lot of liquidity. So let's drop down into the lower time frame. Look at this. You see all this consolidation here? Retail see this big move after that and they go, okay, yep, big support area here. So I'm gonna put my stop here. Also note how all of these double bottoms, right, triple bottom, that's a retail pattern, they go long here. So that's where retail stops are, correct? So what do we then get? Well, right here, retail goes short, right? You see how we break down below this trend line here? That's a sign of retail going short. So there they go short, stops above there. And then we have our order block right there. All the way up there is the big order block on the 5 minute. And yeah, in this area here, the banks are just filling up their position. So we could have fallen already here, but we did another set up. I believe this is inducement here. So when this additional move down comes, that's when retail goes short. So now they don't really dare to go short again after their stops are taken for a second time, right? They're stopped out, they're stopped out. So then they go, nah, I'm not in this trade. That's basically what they think. But basically, the most important part is this entire move up here is taking out retail stops and banks positioning themselves. That makes this an order block. An order block is a place where the banks are buying up their positions. That order block is validated with the break of this low, right? So now the banks have their stops all the way up there because they bought on this move here. So their stops are here. So it would be illogical for the banks to take out their own stops. Is that logical? It would be illogical for the banks to take out their own stops. Therefore, we do not anticipate a move above here before we take out the liquidity where the banks can start to offload their positions. So we anticipate a reverse move in this order block that we have here. Now, within this order block, we have a additional order block, which is this one. Let's drop down to the 1 minute time frame here. Right here we are. So, why is this one an order block? Well, it takes out this trend line high there, and we also build up a bit of liquidity right there, right? This fake move down here, retail goes short, stops above that high there. So this move takes out stops, but on the 5 minute, it's untapped. You see that? How that low there? It's not tapped because this big move comes, so they don't have time to fill up the positions here. That means that the banks have orders right here. So that is where in this big order block we anticipate another move down to come. Now, what do we want to see before that? We want to make sure retail are out, okay? So what do we get? We get beautiful, beautiful inducement. See this move down right here. I've already drawn an arrow to it, right? So that fake out, this specific candlestick. On this one, retail goes short. So now what happens is we get a lot of stops right here, right? Because this is a trend line breakout and it's a break of a previous support. So retail goes short here. That means a lot of stops are engineered right there, which will allow for the banks to position themselves. So they can position themselves in the order block they have prepared beautifully, beautifully. So we have our drawn liquidity all the way down here. We have inducement on this one, taking out retail and preparing stops so that the banks can position themselves. And we have an order block up here on the lower time frame, and we have a higher time frame order block, right? So many factors telling us, yeah, this is a good trade. Okay, so that was the best setup of yesterday. Now, how did we find our bias? What I want to say this again. What I like to think is, where are the retail stops? So retail stops are here, but then when we get this one here and we break down below, that tells me, okay, we are engineering stops right above there. So smart money wanna go short later, but to do that they have to engineer liquidity so they can position themselves, right? They have so much money, so they can't just enter into the market. They need retail stop loss orders, which are right there. So to find the bias, I just like to see, okay, we have a consolidation, we fake out towards one direction, take out the stops in another. That means, okay, smart money did this move because they want to position themselves for a short. Is that logical? I hope it is. Retail goes short, stops, retail stops there, smart money can position themselves. But yeah, let's drop down into the 1 minute, just double check. Yeah, so also here, again, engineers even more liquidity, right? We know we want to go short here because the banks engineer stops above here, right? This is a pattern, classical retail pattern, this one. So we get this breakout below, stops are gonna be above there. We get this another pattern here. Notice how this one breaks this trend line here as well, right? Even more stops. So they fake out bearish, take out the stops they engineer for retail, and then we fall down into our higher time frame draw, which is where retail has their stops. This was a beautiful, beautiful setup. I hope some of you caught it. Yeah, please like this video if you learned anything, so I know I am to continue with these, because this is how trading works. And I want to teach you all, but I need to know you like it. So, yeah. And also, watch my first video for the logic in how I was able to call the big crash. Okay? Because it's the same logic here. So people who say, yeah, this crash was just random. No, it wasn't. Look at my first video and you will find out why it wasn't. Okay? Good luck. Good trading next week. I'm sure it's going to be a really, really good week. And I will give you my bias tomorrow. So have a good day.